We're jumping straight into SanDisk today. Everyone is watching the price action, but the real story is the unprecedented AI-driven shortage in memory chips.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of what might be the craziest chart of 2026 so far, do yourself a favor. Subscribe and hit the like button. We are here to help you simplify your portfolio decisions, and you really don't want to miss what's coming this earnings season.
So yeah, let's look at the board. If you've pulled up a quote screen anytime in, the last 3 weeks, SanDisk is it's unavoidable. It's sucking all the oxygen out of the room.
It has gone completely vertical. I mean, we are sitting here late January 2026, and the stock has already doubled this year.
Doubled. That's a 105% move in less than a month.
And that's not even the shocking number. If you zoom out to when it spun off from Western Digital back in February of 25, we are talking about a 948% return.
Which puts it firmly as the top performer in the S&P 500. It's hitting new highs, $400 or $500 a share. And for a lot of people, there's this dissonance because you say SanDisk and they think, the little USB drive they lost a few years ago?
Or the SD card from their old camera?
Yeah.
It was always boring kind of commodity storage play.
Yeah.
So that's the real puzzle, right? Why is a company that sells, digital buckets suddenly trading like a hot tech stock?
Yeah.
Is this all just hype?
I'd say it's mostly fundamentals with a very healthy dose of market mania on top. We're looking at a perfect storm. You've got this AI infrastructure demand shock.
Right.
Colliding with a supply chain that just can't react fast enough.
Well, let's look at the receipts because the numbers they just put up for Q1 were genuinely shocking. I mean, you expect mature hardware companies to beat by, a few pennies?
Yeah, a beat and raise in the sector is usually like 5 cents over consensus. SanDisk reported earnings per share of $1.22. Wall Street was looking for maybe 77 cents.
That's a 58% beat. You just don't see that.
You don't. And revenue was up nearly 23%. But, markets are forward-looking. The thing that really lit a fire under the stock was the guidance.
They basically said this wasn't a one-off.
Yeah.
They're projecting fiscal 26 sales to jump 42%, over $10 billion.
And the EPS projection is even wilder, up 350% to around $13.46 a share. That's huge operating leverage.
It is. Which brings us to the why. This isn't from selling more USB sticks at Best Buy. It's all about something called BuyCS8 technology. I've read the white papers.
Yeah.
Sounds impressive, but can you break down what that actually is for us?
Sure. Think of it like building real estate in Manhattan. When you run out of land, you have to build up.
Okay.
BuyCS8 is their newest 3D NAND. They're literally stacking memory cells vertically, hundreds of layers high. It lets them pack an incredible amount of storage density into a tiny space. And, this is key, do it with much better energy efficiency.
And energy efficiency is the magic word for data centers right now.
It's the only word that matters. AI models are. They're power-hungry beasts. Everyone talks about the GPUs, the brains doing the thinking.
Well,
but that brain needs a massive amount of memory to store data, and it needs it instantly. If your storage is slow or eats up too much power, you're just throttling your very expensive GPUs.
so SanDisk isn't selling to us. They're selling these high-capacity enterprise SSDs that go right inside the servers at Google, at Microsoft.
At all the hyperscalers, exactly. And here's the moat. Once a data center qualifies a specific drive, like one of these BuyCS8 drives, the switching costs are painful. They can't just rip them out next quarter because a competitor is $5 cheaper.
It creates a sticky customer base.
Very sticky. And it's not like the competitors are flooding the market with cheap alternative either.
No, that's the other side of it, the scarcity.
Right. Samsung and SK Hynix, the other big guys, have openly said they're raising prices by 20%. They're telling the market, we don't have enough. It's a seller's market, plain and simple.
Which explains that operating leverage. You raise prices 20% on a product that costs the same to make? That's pure profit.
Pure profit. But we have to talk about the other force at play here, and this one has nothing to do with fundamentals. It's the pain trade.
Ah, the short squeeze. I saw reports that short sellers are down, $3 billion on this move?
A total bloodbath for the bears, and it creates this feedback loop. You have funds that bet against it, thinking it was a bubble, then the earnings hit, the stock pops.
And they get margin called.
Their brokers force them to buy the stock back to cover their losses, and they're buying. It just drives the price higher, which triggers even more margin calls.
It's a stampede?
It's a stampede. Short interest is down to about 7.4%, But the squeeze risk is still flashing bright red. A lot of the buying pressure right now isn't from people who love the company. It's from people forced to stop the bleeding.
But even with that, the bulls still have a valuation argument. I was looking at the price to sales. SanDisk is trading around 7 times sales.
Which sounds high, but the sector average is closer to 8.7. So relative to its peers, it's actually at a discount.
And the PEG ratio, price to earnings growth, is like 0.27. Anything under 1 is usually considered pretty good value.
And that's the core bull thesis in a nutshell. Yes, the stock is run up, but the earnings are growing so insanely fast, that 350% number, that the stock price is still technically trying to catch up. They'd argue it's still cheap.
Okay, that is a very rosy picture. AI demand, a tech moat, pricing power. But, we have to be the adults in the room. Stocks don't go up almost 1,000% in a year without building up some serious risk.
Gravity is undefeated. And for the bear case, you have to start with the valuation metrics the bulls don't talk about, like the trailing price to earnings ratio.
It's over 1,200. I think the number is 12,211.
Which is astronomical. Now, to be fair, that's a trailing number based on week past earnings. But even the forward PE, based on those rosy projections, is in the 25 to 35 range.
That's a pretty standard tech multiple.
It is, but it's priced for absolute perfection. There is zero room for error. If there's a tiny hiccup, that multiple collapses, and technically the chart's just gone vertical. It's screaming overbought.
It feels like a game of musical chairs. And that brings us to maybe the biggest risk of all, the cycle.
Yes, this is what new investors always forget. Memory chips. They're commodities. They are not software subscriptions. This industry is famous for these brutal boom and bust cycles.
It's like the old hog cycle from Econ 101, isn't it?
That is the perfect analogy. Pork prices go up, so every farmer breeds more pigs. But it takes time. By the time all those new pigs get to market, there's a glut of pork and prices crash.
And building a chip fab takes a lot longer than raising a pig. It's what, 18 to 24 months?
Exactly. Every single time this happens. SanDisk, Samsung, everyone sees these high prices, and they rush to build more factories to capture that profit. They invest billions, and inevitably, supply catches up.
And then you have glut. Prices crater, margins disappear, and the stock tanks.
We've seen this movie a dozen times. The bull case says this time is different because of AI. The bear case says supply always catches up.
And anyone holding the bag at $500 a share is going to feel that. There's also the fact that SanDisk is still basically a new company, right?
Less than a year since the spinoff from Western Digital, it's still finding its legs.
They just added new board members, like Alexander R. Bradley.
Which creates governance uncertainty. Can this team execute during hypergrowth? It's a real risk. And then you just have the mania factor.
Options market.
It's a casino. Call option volume is through the roof. Implied volatility is sky high. That tells you people aren't investing in the business. They're just gambling on momentum.
Mind the chart, not the company.
Exactly. And when the price is driving the narrative, things get fragile very, very quickly.
So we have a huge divide. Bulls see an AI dynasty. Bears see a cyclical bubble. And it feels like the moment of truth is coming up fast. January 29th.
Earnings day. This is the Super Bowl for this stock.
The official Wall Street consensus is for EPS around $3.18.
But you have to be careful with that number. That's the official bar. The whisper number, what the aggressive funds are really betting on, is much, much higher.
I saw a note from Cantor Fitzgerald talking about a potential for $10, maybe even $12 in the March quarter. That is a massive gap.
It's huge, and it sets a dangerous trap. SanDisk could report, say, $5 in earnings, crushing the official estimate, and the stock could still tank because it missed that whisper number.
It's all about the expectations game. So when that report drops, what are the 3 things we need to look for?
First, guidance. They need to say explicitly that this shortage will last deep into 2027. Any hint that supply is catching up will break the thesis.
Okay, longer shortage. Number 2.
Margins. We saw gross margins around 20%. That has to hold or go up. If margins slip, it means their pricing power is fading.
In number 3.
Confirmation of that pricing power. We need to hear them say, yes, we are raising prices just like our competitors. If you hear the word discounting, that is a huge red flag.
There's one last signal I find interesting. The institutional money, the smart money, seems kind of split.
It's very mixed. You have the big, slow money like the Virginia retirement systems buying in, but then you look at the 13F filings from sharks like Ken Griffin. They were trimming their stakes late last year.
That's a classic divergence. The fast money is getting out while the slower pension funds are getting in.
It's a signal worth watching. If you see more hedge funds getting out while retail piles in, that's a classic distribution pattern before a top.
Okay, let's try and bring this all together. SanDisk has clearly transformed from a simple commodity maker into a critical piece of the AI revolution. They are selling the buckets in a digital gold rush.
No doubt, the growth is real, the shortages are real, but the memory cycle is a history book that tends to end the same way every time. Gravity eventually wins.
So it comes down to your time horizon and maybe your appetite for risk. Seems like the momentum is there, but you're buying at 52-week highs during a massive hype cycle.
Yeah, buying parabolic charts is historically a great way to lose money. But missing a true paradigm shift is also incredibly painful.
So here's the final thought for you to chew on. We know the shortage is real today. We know SanDisk is printing money right now. But capitalism hates a shortage. Every factory on the planet is rushing to build more chips to capture those profits. The question isn't if SanDisk is making money now, it's whether you're buying the start of a dynasty or just the peak of the cycle before the glut finally hits.
That is the multi-billion-dollar gamble right there.
That is the lowdown on SanDisk. If you found this breakdown helpful, make sure you are subscribed so you don't miss the next one. We'll see you then.